Ladies and gentlemen, Forbes, the famous news agency, just reported and published an article and say that the S&P 500 could fall as much as 40%, and that's a frightening prediction. So let's just analyze it and see what this prediction is about and what should we do about it. So the S&P 500 has been issued a warning about a overvaluation trigger that has just sound off, and I think we should talk about it and see how bad it could get. As usual, these are my disclaimers. This is only for education and entertainment, not financial advice. And let's go. So the Forbes magazine has just issued a warning and said that the S&P 500 to crash by 40%. Thank God it's a question mark. And I'll walk through you the article and explain why they make such a claim. So it's about a 40 points indication by this thing called the Shiller Price-Earning Ratio. Now, I'll walk through you in detail what on earth is Shiller Price-Earning Ratio. Some of you all probably won't even know what price-earning ratio is, let alone Nobel Prize winner Shiller. And the Shiller price ratio right now sits just under 40. And this would mean that an investor, for every $1 of a 10-year inflation adjusted earnings, would pay $40 for the share price. So now the Shiller price earning ratio in a normal time should be between 16 to 20, but now it's close to double that level. So it is very scary, and it simply means that our stocks right now are overly inflated. So to understand what on earth is Shiller price earning ratio, maybe I'll give a comparison between traditional price earning ratio and Shiller price earning ratio. The traditional price earning ratio simply take the share price of a counter divide by 12 months of earnings. And basically it gives a snapshot of the share price divided by a snapshot of recent earnings. So it's based on recent thing. Some people even use this to predict forward-looking price earning ratio by taking forward-looking earnings and then take the price divided by forward-looking earnings and things like that. But the truth of the matter is that they're all looking at recent or future kind of price earning statistics, and is highly distorted by economic cycle, and a lot of analysts use this price earning ratio to judge whether the price of a stock is expensive or not. But in the Shiller price earning ratio, Shiller is of course named after Nobel Prize winner Shiller, and Shiller price earning ratio takes simply the price of a stock divided by 10 years of inflation adjusted earnings. So when you take a 10-year inflation adjusted earning, it smoothen out short-term volatility and is also review long-term valuation. At the current level of 40, it is a very high level, and it also measures the entire market health. So it is the analogy that could be seen is you judge the condo price by this year rent. That will be traditional price earning. And in the Shiller price earning, you judge it by 10 years of average rent. That's inflation adjusted. So in some sense, it's more average out. So it basically is a measure of how expensive or how cheap a stock is. Never mind if you don't understand what Shiller price earning ratio is, it basically says this. Whenever the Shiller price earning ratio exceeds 32, major market correction has followed. I give you three examples historically. Number one is 1929, during the peak of the stock market. The Shiller price earning ratio was about 32.6. Then the market collapsed. That resulted in the Great Depression, and the market collapsed by 83%. That's really serious. And in the 2000 dot-com bust, the Shiller price earning ratio was about 44 points, and the S&P 500 went down by half. And in 2021, the Shiller price earning ratio was about 38 points, and that collapsed by about 25%. So what would the number be this time when if it ever collapsed? Could be a number anything between 25 to 50%. We don't think that you will ever collapse to 83% because those days of Great Depression has a lot of other factors involved in it. But a downside of 25 to 50% is not unthinkable. So the downside scenario in absolute terms looks like this. If the same Great Depression scenario were to happen, then we are looking at the S&P 500 collapse to 1,150 level. That's a nightmare scenario. And if it collapses by 50%, that would be the equivalent of dot-com bust. The S&P 500 will raise down to about 3,400 points. And if the S&P 500 were to have a 25% decline, it will go down to 5,000 points. So the current level right now is close to 6,700 points. So, we are all looking at this kind of range. The perfect storm right now could happen in a sense that we now have an overvaluation that could potentially blow up like a bubble and burst. We have talked about that many times. It accompanies by a potentially persistent inflation that refuses to go down. Trade tension between US and China have been on this start stop level. Suddenly it blows up big. Things could happen. There are labor restrictions right now as Trump clamped down on immigrants, and of course the U.S. debt level. I personally think there is a problem that hopefully over time will go down. But let's say it did not go down fast enough, then it coincided with this bubble burst. Then we are in trouble. Now, we do have a sign that people are taking flight elsewhere. So gold prices right now has crossed an insane level of 4,200 points. Those people have bought gold in the last 1 to 2 years, they have made a hell of money. And for those people who have been sitting on Bitcoin, by the way, today Bitcoin went down to about 100,004 points. And I think this is clearly also a sign that they are attracting funds from other alternatives as well. But if you talk to the stock market bulls, they always say this time is different. By the way, this time is different is a very dangerous statement. So let's share with you what everybody is saying about why this time is different. Well, this time is different because we have got an AI and tech revolution, and the productivity gains are insane. Every night during live stream, I try to share with everybody some breakthrough AI technology that most of you have a jaw-dropping experience. And this time it could be different. A lot of people say that there is no alternative. So apart from equities, what could you invest in that give you these kind of high returns? Now, there's also a lot of flight to safety in the sense that a lot of the global investors are now investing to US because the US assets are most attractive right now. Okay, and the companies are doing a lot of share buyback, and they also think that if anything were to happen, the Federal Reserve would be there to bail everybody out, which is true over the last few crises. And of course, right now we have got many companies that are doing very well, especially in the tech sector. The support level for these companies in terms of pricing is good. So things like that, right? So the bulls are very positive because of all these reasons. Now, just to put into context, if a crash were to come, it could come anytime between 1 to 3 years, according to history. Should the Shiller price earning signal crash the market, market could adjust by 25 to 50 points. So maybe one of the signs we're looking at is maybe we do have 1 year to 3 years, right? If you want to be conservative, maybe take a 1 year perspective. Now, there are kind of some mitigating factors. It is when we talk about crash, it's not like in one day the market will crash by 25%, 30%. There are circuit breakers that stop the market from failing. So hopefully when that happens, the Federal Reserve will come in and intervene. And of course, a lot of the central banks globally will come together and coordinate a measure to stabilize the bank. Now, these are hopes, right? If should a market crash happen, we hope that the central banks and economies will get all their act together. So it will not probably be like 1929 all over again. So what should we do? Well, the truth is, I don't know whether it will happen, right? And there's no way I could predict, right? I don't have the foresight of God and things like that. But I do know, and I've been warning people again and again and again that we should always rebalance, 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 right? And that's just part of a healthy climb of stock market. I can't tell whether the market will crash or not. But I do know that if you have single stocks, uh, it's very dangerous, and all of us should prioritize globally diversified portfolios and things like that. We should always keep lots of dry powder. We could need it in life or could need it to fire. And of course, a lot of people think that this market will go up and go on forever. I don't think so. Okay. I just that I don't know when it will crash. So in the event, if the market do crash, don't panic if you have prepared yourself well enough. A lot of times the market will recover. So avoid over leverage and make sure you got dry powder and make sure you manage all your risk. It is true that at our current valuation right now, Shiller PE of 40 or any other measure you use, we are paying extremely high price for the current stocks. And this could be seen as a bubble or could be seen as a birth of a new era. I would take a more conservative approach by just rebalancing. Now, let me remind everybody again that you do not need to have the foresight of God to be able to predict crashes, survive them, and profit from them. I don't think you need. As long as you play it safe, okay, accumulate cash, and also let whatever portfolios you have continue to ride the wave. Should there be a downturn, you have your cash, you can jump in and profit from it, and that's fine. So a key takeaway is this. The warning that's given by Forbes is there is historically a precedent that whenever it hit 40 for P ratio, generally there is a crash that will come. And this time around, the crash could be precipitated also by other high risk factors. So what we should do is stay protected, diversify, maintain liquidity, and take care of your risk. So with this, I just want to say, play it safe. Okay, we do not need to invest money that we need to chase money that we don't need. That's very unwise. So let's just watch and see whether what will happen. And meanwhile, let's just play it safe. I'll see you in the live stream. Bye bye.